slightly lower. So steel, some banks on the weaker footing as we speak. The Nifty is also losing ground. Now the 40-point pop is just about a 20-point pop. Gainers include Bajaj Finance and Finserv because of the reasons that Abhishek mentioned, 28-29% AUM growth, lots of positive brokerage commentary rubbing off quite well on the stock. Titan's numbers are being well received by the market, 1.5% higher. There is Shriram Finance, SBI Live. These are some of the other names that are up and about. And tech is starting with hope and promise because it is the beginning of the earnings season this week with TCS. So you've got Infosys, Tech Mahindra, Wipro, HCL Tech, a little bit of a tinge of green on most of these stocks. But we have to watch for the banks because they're offsetting whatever little excitement that the tech stocks are showing. The Bank Nifty is now down about 45 points at this point.
Well, that's right. Just take a look at a few more stocks, Surbi. Angel One, their trading update, in fact, is ahead of most estimates. The average number of orders declined by around 21% month-on-month. That compares with an expectation of a 30% decline. The client acquisition as well increased quarter-on-quarter. MTF book increased quarter-on-quarter, and market share is more or less stable. Explains why that stock is up close to around 5%. Jubilant Food, we had highlighted this last week itself. There was delivery-based buying being seen out there. There were some shots that were getting covered out as well. The stock has made a fresh high post the Q3 numbers. So big move is what we're seeing on that one. Easy Trip, we had Mr. Nishant Pitti who joined us, and he clarified that neither him nor the other promoters are looking at selling any stake. Explains why the stock has opened up higher, but we'll have to see how long it can stay at those levels. For the time being, big volumes up close to around 8%. DCX Systems, another stock that was on the radar last week as well. We're seeing some bit of delivery-based buying. They've gone ahead and won a large order. The street likes that. So explains why that stock is up and about in today's trading session. What's on the downside? We have Dabur that's down close to around 3%. So that comes up for you on the screen. United Spirits is seeing some kind of profit taking. And Union Bank is down close to around 5% or thereabouts. But otherwise, green on the screen. The Nifty holding with mild gains. HDFC Bank, that's down close to around 0.5%. I think that's going to be the swing factor for the day.
Okay. SBI Cards, let's just quickly chat about SBI Cards because there was an upgrade from Nomura. Target price now set at 825. Nuvama has upgraded it to a buy. Their target price is 850, and it's a strong start for SBI Cards as it gains close to about 4%. Nykaa is another one opening up with strength. As Mangalam was just telling us, the BPC, the beauty personal care category, has seen a growth of 30% plus for the company, and that's a positive opening. Macro tech developers also came out with their Q3 update. The company has reported the highest ever pre-sales. Pre-sales in Q3 went up by 32% on a year-on-year basis. The company has brought down its debt. It's a good opening for macro tech developers. Another real estate stock is Brigade, where the company has just announced that they are planning to develop a residential project in Bengaluru with a gross development value of 2,700 crore rupees. JSW Energy, another one we were tracking, has opened with a cut of nearly 2.5%. And pull up HUL because there were some reports which suggested that the company is looking to snap up the skincare startup Minimalist for about 3,000 crore rupees. HUL, it's a report as of now. CNBC-TV18 has not confirmed it. It's a flat opening for HUL, and ITC I don't think that's got a trade right now. It's just waiting for it to, the price discovery.
Yeah, the price discovery will happen for an hour.
For an hour, so no trade yet on. And Kotak Mahindra Bank, on the back of the CTO resignation, is also on the back foot.
Just one word on HDFC Bank. That one, in fact, it moved briefly into the green. Now it's still down, but it's down marginally. It's come off a little bit from the low point of the day. So that's the stock, I think, to track for today. Its low today is 1,736 rupees odd. The street was prepared for a softish showing. It is a little bit softish, but let's see whether or not we see a bit of a bounce from the day's low.
Banks are really playing spoil sport. No denying that, because Bank Nifty is down 120. But what's happened is that even for some of the larger franchises like HDFC Bank, even if they're mobilizing deposits, the question is at what cost? And in HDFC Bank's case in specific, it's more term deposits. You have to pay more interest on those term deposits. They don't come as cheap and convenient as CASA. And CASA ratio has declined for the bank even quarter on quarter. So those are some of the concerns perhaps that are weighing on the stock this morning. But more on the markets with our next guest. Our market master of the morning is Devina Mehra, founder, chairperson and managing director at First Global. Devina, great to see you in the new year. First of all, wishes and greetings for a very happy, healthy and, of course, wealthy and prosperous new year as well. So let's start right there. The interesting factor is that as we were collecting a lot of the opinion as 2024 was rounding up, for the first time in many years, people were really tempering expectations. Even the poll that we did a street viewer street poll that said that, expect maybe just high single digit to low double digit returns in 2025. Do you share that sense of cautious optimism, if I could call it that?
Hi, and wish you and your viewers also a very happy new year. May it be a blessed year for everyone. So coming to the one-year expectations, I have never given a one-year picture either in January or at Diwali time. And I recently wrote an article precisely on this, that what you should do with one-year projections. First of all, you should see what people said a year ago, 2 years ago, 3 years ago, because Bloomberg actually did a study which went back 25 years and all the big names in the world. So all the Goldman Sachs and the Merrill Lynch's and HSBC or Deutsche Bank or Citicorp and all the people listen to very carefully that they have a hold on what's going to happen. And the projections were off on the average by 15% points. So if somebody said the market will be up 10%, it could be up 25 or it could be down 5. And everybody clusters together because it's easy when everyone is wrong together. So I mean, so that should tell you what to do with one-year projections, because that's in a category called objective ignorance, as Daniel Kahneman calls it. That is not just a thing you don't know, but you cannot know. But coming to expectations, yes, I think expectations in general have run far ahead of where they should be. I have people coming to me and saying, yes, I'm fine with a conservative portfolio. I'm fine with 30% return a year.
So 30 is the new conservative, huh? That's the problem that we're dealing with. But Devina, hasn't a lot of that started, tempering? Because we have seen a time correction, maybe not a very savage price correction, but definitely a time correction. The market hasn't been galloping one way higher like it used to. I mean, we've been in this zone for now a little over 3 months.
Yeah, I mean, as you should be. If you go back again 18 years, if you look every year, there have been only 3 or 4 years where we haven't had a double-digit correction. So in 2023 also, we did not have it. So you can say after 2 years, you saw just in the double-digit category. So it was not something which is unexpected if you are really an observer of the markets and really look at data. So we had been expecting this. Of course, we bought hedges in the middle, but the market continued to run up. So we were cautious in March. We were cautious in June before the election results, but we did not go into cash. We bought hedges. So this year we've spent some money on hedges, but that's like, we didn't get used in a sense, but that's like buying health insurance and not getting hospitalized. I don't think it was a waste, but this was not something we were not expecting. As far as the situation now is concerned, I think if you have made money in very frothy areas, time to move to a steadier, more conservative portfolio, because I don't still see a big risk in the mainstream larger stocks, which is not to say that the market can't go down another 5%, it may, but I'm saying I don't see a big risk of a crash, because that comes when you're way out on the return trend line and you are still not there, primarily because 2010 to 20 was a very bad decade for the market. You didn't even make anything more than fixed deposit returns for a whole decade. And that's why you had this bull run. I mean, from, I think, the COVID lows, the Nifty is up something like 220% and the 500 is up some 270%. So we've had a great run, but I don't think you are still in that territory where you will we're looking at a crash. The small cap, micro cap, that category is different, because again, people with a very who are very new to the market don't know that in every bull run, some of these stocks that run and then there is a correction or crash or whatever in the next uptrend, it's not the same stocks that go up in general. So, keep that in mind. So, as I said, if you made the profits, or even if you haven't, get out of the frothy areas and get into more conservative portfolio, steadier portfolio, and properly risk managed.
Devina, in the past, you've highlighted how banks, despite being a consensus overweight, hasn't really given oversized returns to investors. They have largely underperformed. Now going into 2025, what's the call on the banking and financial sector? And pharma seems to be a big overweight for you.
Yes, pharma has been an overweight since, I think, first or second quarter of 2023. And again, pharma had a poor run prior to that for many years, which created the room for this up move. And so we continue to be overweight pharma. Of course, in the next 10 days or so, we will be doing a quarterly rebalance. So, but we are still overweight pharma. We are overweight auto components and IT. These would be our overweights. Capital goods, industrial machinery, which we were overweight for 3 years, unlike most fund managers who discovered it in 2023. We were overweight from 21. Now we are underweight. So that is the picture as far as pharma is concerned. And what was your other question? Sorry,
Banks.
Said on
Banks, I think is what we.
Yeah,
And I
banks.
think Devina, if I remember correctly, you have been underweight banks, right?
Yes, we have been almost always underweight banks since we started the PMS almost 5 years now. As someone was saying, you repeat this in every interview of yours, that I am a nervous investor in banks and lenders. And the primary reason is that that's a thing that's an area which always gives negative surprises. And if you look at from 2020, in the past 5 years, it has underperformed every single year except 2022. And 2022 was the only year where we were market weight to slightly overweight on banks. Otherwise, we are almost always underweight. And if it wasn't the biggest weight in the index, probably I would love not to look at it. But even last year, if you see, the Nifty is up more than 10%. Of course, the broader indices are up even more, and Bank Nifty is up 5 and odd. And 2020, it was the only sector which was the only major sector in the negative. 21, again, it was half as much as the market. 23, again, underperformed. So every year, if you see, they generally underperform. And so that's the thing, that that your lender, your borrower does very well, you don't get anything extra. So you are in a highly leveraged business where the only thing is your kind of luck part is not there on the positive side, it's there on the risk side. And if you look at the numbers also, I think now there is in the whole credit system, may or may not be exactly the banks, there is, I think, pressure building up on credit. A lot of indicators like that, like gold loans going up, which means people are forced to mortgage jewelry. And then this is something I heard Mr. KV Kamath saying, and that was a light bulb moment for me, that if you look at the two sides, that if you look at all the losses that are made, let us say in the FNO market, which is, I think, something of the order of 1.5 lakh crores, and that's likely mostly funded through these unsecured credit. And of course, there's issues on the deposit side also. So, and also remember, theoretically, also bank margins go up when interest rates go up. Which is when the loans get repriced immediately and the deposits, the interest rate goes up for the slowly. So now you're again not on the right side of the cycle there. So those are all the concerns. I mean, it may be a market perform, I think, at best, banks.
But Devina, so, kudos on the pharma call, because actually if there's something that's worked really well in the last year, is actually pharma and healthcare. They have been the best performing indices. But I'm coming back to your point. You're saying stay away or, clear a bit of the froth in your portfolio. It's time to get a little conservative. Now, how else do you do that? Banks, you sort of outline some of the concerns that you have. Healthcare, you're overweight on. But how else do you take that conservative stance? When FMCG, we've been discussing this whole problem of anemic growth, for instance. And wherever there is growth, one can argue valuations are maybe still elevated. I mean, whether you're looking at jewelry stocks, you're looking at a Trent, etc. So how else do you get conservative, and which is the frothy part of the market where narratives are still strong, but you still see some froth? I mean, whether it's EMS or renewables, EV, the narratives are going very strong. But are you concerned about the prices?
Yeah, I mean, we don't generally go to those kind of frothy areas. If you look at, for example, there were a lot of defense funds that came out in the first half of 2024, and they have underperformed. So I always say that one easy thumb rule is to know where froth is to look at the areas where the new fund offerings are coming, because that's normally when that theme has matured and is close to the peak is going to likely fall from there. So be concerned about that. If you are in micro caps or stocks generally below, let us say, 5,000 crore market cap, that's an area where risk management is very hard. So if those stocks fall, your stop losses don't work because they just keep falling. And also there is no hedge available because the only liquid hedge is on the Nifty and on the Nifty put, and then that doesn't move with the small cap. So that's like some easily identifiable area. Any new area that's coming up, if you want to have an exposure, have some exposure, but that should be a small portion of your portfolio, because companies with no history are inherently risky. And also remember that even if a company is doing well in a particular, if they've created a space, if they've created a business where none existed, if it's very attractive, that will draw in more players, so more competition, pressure on margins, etc. So, all those things also are there. So be careful. FMCG, yes, I mean, we've been watching for the last few months, and we have increased exposure in the middle of the year. But that story has been stalling. I mean, I'd seen, of course, the consumption slowdown has not come in the last 2 quarters. If you look at financial year 23-24, and you look at the GDP number, the private consumption number was at a 21-year low or something. So, I mean, people started looking at it only when the market started correcting.
Yeah.
But the problem is that the inflation has been a little more persistent than I thought. I thought good monsoon now, food prices might go down, and therefore that will be a relief for the FMCG. But then, palm oil prices, everything has been quite strong. So, but I think, I mean, FMCG is probably somewhere in the bottom area now. It may not be the standout performer, but it's not looking too bad either.
Okay, so, perhaps something on your radar. And let's see, we'll take that up in our next conversation. But thank you so much for joining in. Once again, wish you a fantastic 2025 and look forward to more conversations. By the way, speaking about the slowdown, guys, I don't know, I mean, there were a lot of articles over the weekend talking about how the sales, end of season sales, the discounts are ranging between 70-80% because there's so much inventory that these brands are trying to clear. So I guess a lot of it, because the companies are not listed, or the brands are not listed here in the market, doesn't get captured. But I suppose it's just another sort of facet of this urban consumption slowdown that we're talking about. Anybody heading to the mall over the weekend? 60, 70, 80% discounts apparently.
Okay, all right. Well, let's move on. Let's invite our next management on the show. We have Rainbow Children's Medicare. That's the next stock on our radar to discuss the expansion plans, business outlook. We're joined by Dr. Ramesh, the chairman and managing director at Rainbow Children's Medicare. Hi, Dr. Ramesh. Good morning, and thanks a lot for joining in. Well, I've had the privilege of visiting your hospitals in South India, and boy, oh boy, you're taking care of the little ones, and best in terms of medical assistance is what I understand in parts of India as well. Well, tell us, Dr. Ramesh, how are things shaping up? You have big capacity addition plans. I think you're close to around 2,000 beds. Tell us about how do you see these capacity additions take place, and also a word on your expansion in North India, namely Delhi, Gurugram. I believe that out there you're looking at increasing your beds by a couple of 100 beds. Tell us more of that.
Yeah, thank you, Nigel. Happy New Year to you. So our the bed expansion almost we're going by 50% in the next 3 years' time. By calendar year 27, and I think we'll be adding about 1,000 beds. Most of the beds, about 450 beds, are going to be in Gurugram, and the rest of the beds are going to be in the south, mostly in the form of regional spokes as well as the city hub and spoke model. So this is how we are looking at it. In terms of Gurugram, we are kind of almost close to obtaining permissions. We are kind of planning to do a groundbreaking towards end of February or first week of March. So from there, I think it will take about 2.5 years' time. Maybe by 27 mid-year, we'll be operating both the hospitals in Gurugram.
Okay, all right. So 400 beds is what the addition is likely to be in Gurugram itself, out of the total 1,000 that you're looking at by 2027. Is that correct?
Yeah. We have a possibility of 200 beds coming in the form of acquisition, which is we are in the initial phase of working on it. Probably kind of we will know in a few months' time.
Tell us, where is that inorganic growth, Dr. Ramesh? I remember pushing you even when you had joined us on Inside Out. I was trying to quiz you, where exactly are you looking at? So this 200 bed opportunity, first of all, the time horizon that you're looking at, And if you could give us a broad geographic idea, is it in that part of the world, the northern India?
Yeah, as I was always kind of been passionate about the Northeast, so that's likely to happen soon, and also kind of the acquisition closer to Hyderabad as well.
So these are two separate acquisitions. Hi, sir. Great to have you on the show, Surabhi here. So you are looking at two separate target entities, one in the Northeast, one in Hyderabad. Could you give us a rough sense of how large these entities are, bed capacity, and what are you thinking right now in terms of funding these? How close you are, and whether the funding is going to be all entirely, through internal cash?
I think the Northeast one is right now they have 100 beds. I think we are kind of working on expanding to 150 beds in the Northeast. In the South, which is one of the tier 2 cities closer to Hyderabad, we are working on about acquisition of 75 beds. So
and by when?
I think these things too should happen in the next 4 months' time, 4 to 5 months' time. This is what we're working on. So, CapEx-wise, so we have a lot of internal accruals. That shouldn't be a problem. We would be kind of taking over majority of the stake in both the places. We still yet to decide how much majority we're going to take.
So your cash was about 580 crore as of September. Will that be enough for you to fund your acquisitions, the two proposed ones, and your capex plans?
Yeah, that will be more than enough at the moment.
More than enough. Okay. And as you expand your bed capacity by FY27, what would the margins of the company look like according to you? Because you've been steadily expanding your margins. So what's the trajectory on margins as you see it?
So we've been expanding in the last 3 years' time, kind of year on year. We are adding about 15 to 18% of the beds. We continue to deliver about 25-26% of EBITDA margins. We never failed on that. So how I look at it is that now what we call is disciplined expansion. So if I'm adding about 250 beds in a year, then that would probably take about EBITDA pressure of a percentage or so for about 2-3 quarters. Otherwise, we'll come back to normal. So we've been witnessing this the last 3 years, and I think we'll continue to grow the same way. The thumb pressure will be there for a few quarters. Otherwise, we'll come back in quickly. One of the reasons our southern business is getting more matured and matured. So as the southern business gets more matured, that EBITDAs are not going to be a big problem for us.
Okay, all right. Just a quick couple of questions then with regard to this EBITDA per bed. I think as of last year, it was 6.4 million. Now, I'm reading a couple of brokerage reports that believe that in the next 2 years, it'll go to around 8 million. Do you think that that could be the aspiration?
Yeah, I was looking at it. I think it would probably closer to the 8 million and may not be exactly 8 million. Suppose if you are growing our RPOPs by 6% year on year, I'm sure we could achieve that, provided occupancy support us with the 55% of occupancy at a group level. We should be able to achieve that, closer to at least 8 million.
Got it. I just want a quick word on the Madhukar Hospital in Delhi. I think profitability is a little bit lower out there. You could help us out with that number. But the belief is that the margins move to mid-teens over there. Could you help us out with clarity on that front?
Yeah, I think it's Madhukar is a kind of would be probably talking about 10% or more than 10% margins. So this is a model where I don't think we will achieve the EBITDA margins of 20 or 25% because of the cost structures, because of the free beds, what we are supposed to do, and also the high rental payouts to the owners. So these are all the kind of stumbling blocks there. Perhaps this is how DDA properties, trust hospitals work. So we are doing well, but the margins are going to be the same. But considering that our capex per bed was quite low, we believe it's okay.
So from 10%, it moves up a little bit, say to 12 to 15% in the coming 18 months?
I think it should go up to 15%. Beyond that, it's going to be challenging.
All right, Dr. Ramesh, you built a great franchise, taken care of a lot of children as well across India. What's the, the succession plan? I believe that your son as well is already on the board, but he's due to join the business. Could you help us out with that succession plan? Because succession is something that the stock market looks at very, very closely.
Yeah, my son is Adarsh Kancharla. He's right now doing a fellowship in London within the transplant fellowship program in King's College Hospital. So he has got a kind of seat in London Business School and is waitlisted in Harvard. So very likely he's going to join one of these two schools in August, September of current year. So we always believe in that. We have been a kind of purely doctors and doctor entrepreneurs. The next generation is likely kind of, if they have come back with a business background to build the organization, will do better. So I encouraged him to kind of go for an MBA. So he's a bright guy. I'm sure with a medical background and business background, I think that's going to be a future asset for a long-term building of Rainbow.
Okay. Thank you. Thank you, sir, for joining in. We look forward to chatting with you when your Q3 numbers come out and as and when those acquisitions close. Thank you once again for joining in. Get into a break. On the other side, Anand Agarwal of V-Mart Retail will join in to talk about their Q3 business update.
Welcome back. Just eye on the market and the color is completely red. Blame it on the banks. But it's not just the banks. Today, even the mid-cap market is feeling the heat. It's not a very pleasant-looking screen early on because there's a decline of 0.5% on the mid-cap index and the bank nifty is really sliding.
You know, the ITC, the initial rates are coming out because we have close to around that 40-45 minutes is over. So the rate that it settled at is 456, which would be a 24 rupee, I think, adjustment in comparison to Friday's close. So that as well will come up for you on the screen.
And there's just one more stock, LTI Mindtree, because there is a double upgrade on LTI Mindtree by Jefferies. It's now a buy rating versus an underperform, and target price stands at 6,650. LTI Mindtree has been an underperformer. So whole of last year, the stock didn't do anything. It was absolutely flat. While the Nifty IT index gave a return of more than 20%. So after this kind of an underperformance, Jefferies believes there is value at current levels. So double upgrade for LTI Mindtree.
Okay, there we go. So some stocks that are in focus, but otherwise the texture of the market is weak, at least at this point in time. What, however, is not weak is the Q3 update that we got from V-Mart Retail. That's the next company on our radar. Now, V-Mart reported what looked like a pretty good operational update for the third quarter. The revenue is up by about 16%. Same-store sales growth has come in fairly healthy in double digits as well. To talk about this, we have Mr. Anand Agarwal, Chief Financial Officer of V-Mart Retail, now joining in. Thanks very much, Mr. Agarwal, for being with us. I'm just pulling out the numbers for the benefit of our viewers as well. 16% revenue growth and same-store sales growth at 10%. It's very good, but if I compare it to the 9-month same-store sales growth, then it's 10% versus 12% for the 9 months. Let's dive a little deeper into what you're seeing in urban, in sort of semi-urban, rural, and what the contours are behind the 16% revenue growth.
Hi, good morning. I must say, I think the going has pretty been good for the last 1.5 years. We've been constantly been improving on our operations, and obviously the macro also is helping. There's definitely far better traction that we are able to see both in the rural as well as in the urban segments. When I say urban, it's not really, so much of the urban customer for us. It's still a tier 2, tier 3 kind of customer who comes even in a tier 1 town for us. So that way, I think what we are seeing is a recovery from the last 2-3 years. Post-COVID, this segment had definitely, gone down a bit. And that is where we also saw our numbers, plummeting down a bit. But now for the last 1.5 years, we're seeing a good recovery, both at the macro level as well as a result of what we have been doing as part of our revamp and restructuring.
Okay, so give us some projections. Now we're almost done. I mean, just last quarter left in the full financial year, right? You grew 20% in the second quarter. Now the top line growth is 16%. So FY25, looking at the fourth quarter, what is the overall revenue expectation that you have?
I think we should still be able to grow at mid-teens or high teens. That's the trajectory that we have set for ourselves. I think quarter 4 is a very small quarter. But having said that, quarter 4 will also see early Eid and probably a winter Holi. So that should bide well for all of us and us included. So I'm quite hopeful that quarter 4 should also pan out quite well. We are also opening a lot of new stores. We have seen a good traction in the new stores that we've opened so far this year. And also the numbers look promising in terms of the performance or the sell-throughs that we are able to see on the ground. So quarter 4 definitely looks promising. At an overall level, therefore, the total growth should be in mid-teens or high mid-teens. At the same store sales growth level, I think high single digit or maybe just touching double digit is something that I would still target for.
How were the discounts, Anand, in Q3? Was it more than normal given the kind of urban consumption fatigue that we're seeing? And what would be the outlook on margins now?
No, I would not say that we put in more discounts. We did not see a lot of fatigue in the segments in which we operate, which is like tier 2, tier 3 towns, not as much in tier 1. We did not resort to a lot of discounting. There was a bit of concern early on due to the late start of winters, but later on, I think pretty much everything is normalized. There's a bit of concern around winters in East India and other central parts of India, but otherwise things probably remain normal. As far as the margins are concerned, I think we should still be able to see the kind of growth that we've been seeing so far. The numbers are still to come for quarter 3. So I would not like to comment so much on the margins, but margins should remain in a healthy range.
And what about LimeRoad? You had earlier indicated that break-even should happen by Q4 FY25. Is that on track?
Slightly challenging. It's a very, very small business, but an important business for us. It's less than 5%. The online business is less than 5% of our overall revenues. We've been constantly improving our performance on LimeRoad and the other parts of the digital business. The losses there have come down by almost 35%. The revenues have also come down. So we are not targeting to buy revenue. We are targeting to make that business sustainable. As far as the break-even is concerned, I am not too sure we should be able to see break-even this year. I think we are still some distance away from that. But the good part is that we've significantly reduced our cash burn. We've significantly reduced our losses from that business. And we are building towards a much brighter and a better online business as a portfolio for V-Mart.
So what's the cash burn right now in LimeRoad? And do you think by the end of this calendar year, is there a possibility it can break even?
Possibly, yes. I will not say again on a full year basis. There may be quarters, there may be periods where we will break even, where we may also have a profitability. But the online business is such mired with such complexities that it's very difficult to run that very profitably at a low average selling price. And our average selling prices on LimeRoad as far as our merchandising mix is concerned is definitely much lower. So we are running it more like a omni enabler for the V-Mart group, and that's the objective. So it will still remain probably a cost center, not as much a profit center in the near future.
Okay, so that's LimeRoad and the digital business. Finally, to come back to the capacity addition and the store rollout plan, I think you're at 488 stores as of December. How many more are you looking to add in this fiscal year, FY25? And overall, I mean, what's the rollout plan for the calendar year as well?
I think on a full year basis, we should be opening roughly around 55, 58 stores. There may be a few store closures that may come in Q4. We've not closed any stores the last quarter, that being the festive quarter. So we typically avoid any store closures in Q3. Q4 may see some amount of store closures, which are very normal, nothing abnormal. So every year there should be 1% of store closures, 1 or 2% of mistakes that we will actually always end up doing. So that will happen in Q4, but on a full year basis, the net store addition should still look like around 50 to 55 stores.
Okay, all right. Anand, we'll leave it on that note. Thank you very much. Once again, wish you, the very best for 2025 to you and, of course, your team at V-Mart Retail. That's V-Mart, but we have to, take the eye back to the screen as well, because this is once again a big decline. The only caveat is that let's keep the context in mind. Today, we're not falling alone. That's the little reassurance, because if you look at a lot of the regional markets across Asia, many of them are also seeing red. For instance, you're seeing the Hong Kong markets lower. The Japanese market is falling actually quite a bit, 1.5% down in Japan. So it's sort of mixed shades. Even the Chinese markets, despite what the PBOC said over the weekend about moderately loose policy, despite that, there's weakness in regional markets. But yes, for us, I mean, the concern continues. The selling in banks, when the Bank Nifty is now down almost 1%.
Yeah, and that's even though HDFC Bank is as flat as can be.
It's still not falling,
HDFC Bank is as flat as can be. So the other stocks, in fact, are contributing, namely Kotak Mahindra Bank, that's under pressure, and a couple of other names as well are lower in today's trading session. Just a few stocks that I want to highlight. Jubilant Foodworks, that's the outlier today. It's in this year itself, we're just not even 5 sessions into the year. The stock is up already around 10%. So that's seeing a good amount of price action. There were a couple of dips that we saw in the last 40 minutes or so, but that's quickly got bought into. So that's one stock that's clearly done well, 12% in the last 1 week, as my director very helpfully pulls up. And Crompton Consumer Electricals. We had highlighted this in the morning as well. The stock has fallen more than 10%, I think, in a matter of 15 sessions. But currently, it's trying to pull back a little bit. It's up close to around 2.5% or thereabouts. It's been a rank underperformer, but that's moving with some volumes as well. So just highlighting that stock.
And QSRs, that's the other theme. So there is a rub-off impact of Jubilant Foodworks on Devyani International, 4% up, and Sapphire Foods, which is up 4.2%. As Abneesh was saying, that QSRs have gone through a period of 8 quarters of subdued growth. So now the base effect is favorable. And so far, at least, some of the numbers from the consumption side, whether it's Avenue Supermarts or even Jubilant, do indicate some positive momentum. So QSR is a pocket which is doing well. And in banks, PSUs, the Nifty PSU banking index is down more than 2%. Union Bank has a fall of 6%. Bank of Baroda, PNB down 4%. Indian Bank, Central Bank, these are under significant pressure.
What's also standing out for me is the fact that even Marico came out with a pretty decent update. Third quarter update was good. They're talking about possibly double-digit growth, and some of their portfolio brands have done really well. But now that is really helping the sentiment, about 4% down on that stock. Dabur is a different story. Dabur anyway has been guiding the market towards a weak quarter, and they've said the pain in this, the general trade channel, that is continuing. So Dabur is also down 4.5%.
Just one more stock, IMFA, Indian Metals, Ferro and Alloys. We've been telling you all here on CNBC-TV18 for the last 10 to 12 months that there is a shortage of chrome ore, globally. And because of that, ferrochrome prices remain more or less steady, irrespective of what's happening with other commodity prices. IMFA is holding with a gain of around 2.5%. Noted investor Dolly Khanna's name had got, turned up in that 1% plus shareholding. So that could be one of the reasons why the stock is holding up with a gain of around 2.5%. And as Nimish has told us in the past, there could possibly be some kind of corporate action that the street is waiting forward to. In the last few days, the stock is up. Last 1 year, in fact, I think it's up close to around 50% or thereabouts. So keep an eye out on that one. And as we told you earlier, ITC, 25 rupees is the adjustment that we have seen on that particular stock as well. That pre-open special trading is out of the way. And this is listed now, X of the hotel business. Well, Rahul Sharma, the Director and Head Technical and Derivatives at JM Financial Services, joins us on the show. Hi, Rahul. Good morning. 2025, hopefully it's a good year. Wishing you, your team, your family a very, very happy new year. Well, you normally join us and you normally give us that one kind of a data point that you're stressing on. What's it this time around? The FIs are net short. So what is the data point, if you could tell us? And also, what are the levels you're looking at on the Nifty for this year?
Yeah, thanks, Nigel. So, the good thing is markets have somehow managed to create a higher low over the last few weeks, and the 23,263 low that we formed in December seems to be intact. Now, this will remain a crucial level as we head into the big, the weeks where we have a lot of events. We have earnings, we have the US, president taking charge, plus also the possible rate cut happening in the first week of February. So I think incrementally markets should get better from here. 23,700 is a crucial support for this week, as markets will try to find their feet after once we start getting into the earnings numbers. And on the upside, I think slowly, gradually, we should be. So two levels in mind: 23,700 for this week, and the panic low that we had formed in December remains a crucial, all-important level in case you were to create long positions at these levels. Now, the technical setup is indicating that we are on the way up. There could be a bit of volatility, which is something there. And secondly, the positioning of the FIIs continues to remain short. That should get challenged once we cross 24,200. So 24,200 once gets taken out, may happen this week, may happen next week. I think the next stop for the Nifty should be at 25,000, which could be a short covering move, which can take the markets higher. So all in all, look to be a buyer on dips, look to buy around the support levels. And we feel that, over the next few weeks, markets should do well from here.
Rahul, L&T, what is the chart telling you?
Yeah, so Larsen and Toubro has been sideways for the last few months, in fact, almost a year now. And this sideways structure is more of a technical, box that it has created on the monthly charts. Now, you could be an investor in this stock. We feel that the stock has got long legs. So, in fact, this is also one of our stocks for the year 2025, which can deliver a return of north of 20-25% on the upside. So one can look to buy L&T at these levels. I think the risk reward is very much favorable. This also is part of the capex theme that is expected to do well over the next few months. And technically speaking, I think this stock has got legs up to 4,500 on the upside. So 25% upside broadly. L&T remains our top pick from the capital goods space, which can outperform the market going ahead from here.
By the way, just taking a minute away from this interaction, just to point out that there's a lot of weakness in PSU banks today. Union Bank is down 6.5%, Bank of Baroda is down 4.5%, PNB, Central Bank of India, IOB. So the entire PSU banking pack, look at that, 3%. That's a crunching blow on the PSU banking space. The Bank Nifty relatively is better. Bank Nifty is down about 0.7%. I just want to put out, I think we'll get Abhishek as well to recap some of the updates, because BOB reported numbers over the weekend, the Q3 update. Union Bank's update I was looking at, sequentially deposits are down. Even year on year, the deposit mobilization is just 3-4%. So very, very anemic compared to some of the other private sector names. We'll put the spotlight on them in just a bit. But Rahul, coming back to you, and banks is really what I want to talk about. I mean, slightly more medium-term perspective. Because this banking move has been a non-starter. You get a couple of good days, a trading bounce here and there on some names, but that big bank move, that's completely eluded the market in all of 2024. What do you see ahead?
Yeah, so at this point in time, clearly Bank Nifty is at a make or a break level. 50,500 to 50,000 are the twin supports for the banking index. It also happens to be the 200-day EMA support for the banking index. Now, clearly, the follow-up buying has not happened in the private banks. We saw them do well in bits and pieces, but eventually, they have to give these big breakouts, which have not happened as of now. So I think the best strategy at this point in time is to switch to NBFCs. NBFCs have done relatively well. In fact, the 21st November lows are still intact in something like a Bajaj Finance. And I think over the next 12-month period, this is one stock where you could keep your eyes on. This stock is something which can come out of the last 3 years of consolidation that it has been. In fact, the stock has been broadly sideways over the last 3 years. and the breakout could very well take us, north of 25% in the same. So, there's a triangle pattern, as you can see on the graphs on the long-term charts, and this has shown resilience over the last few trading sessions. The kind of volume-based buying that has happened is clearly indicating that strong hands have entered into it. And I think if I were to bet a money on one NBFC stock which can do very well, I think it could be Bajaj Finance. So rather switch to NBFCs as compared to what is happening in banks. Maybe wait for a better day and a breakout confirmation. Once that happens, that would be a better play at that point in time. But at this point in time, I think it is Bajaj Finance. It looks pretty solid.
Well, valid point you're making out there, and it's out of the blocks in a flash. It's the top Nifty gainer for this calendar year so far. What are the ultimate targets you're looking at on Bajaj Finance?
Well, technical projections are coming around 9,000, but I think 8,600, 8,700 is where one could look to, look at a target as, which is approximately around 20-25% from these levels.
All right, and the one that has defied gravity in the last few years has been Gravita. The stock pulled back a little bit after they raised some money, but you believe it's good for more. I think that's one of the top picks you have. What are the targets out there?
Yeah, so Gravita is something which is more of a continuation play. The stock did fairly well in the first half of 2024. Post that, it entered into a consolidation correction, time correction, if I may call it. I think, the stock has got a 40% upside from these levels and can be bought at current prices. It has got a pole and flag pattern on the weekly and the monthly charts, which it should, provide continuation in the current uptrend. So I think this can recycle into a new trend, and one can look to be a buyer in this, especially if you have a 6 to 12 month kind of a time frame. This stock can be the best performer of the all the stocks that we've discussed today.
And SBI Life, Rahul?
Yes, so this is one of the bargain plays. So from the insurance pack, this is one stock which is available at a long-term support line. So, as you can see, 2020 onwards, there has been a rising trend line. The stock has taken support over there twice. I think, at these levels, the risk reward is very favorable, for a fresh upside. And, one can look to buy in this space for a potential upside of around 30%. So, insurance play plus the budget also coming up, I think there could be triggers. But at the same time, technically speaking, the risk reward is very, very favorable, and one can look to buy at these levels for an investment perspective.
Okay, all right, Rahul. Thanks a lot for joining in. I think the call that you are making is buy on dips in the near term till the lower levels get violated. And as we had that chat with Rahul, the stock, or the Nifty, the Nifty has recovered close to 80 points from the low point of the day. The few of those IT-related names, well, they are pulling back. They have moved to the high point of the day. So good move from tech as we speak. HDFC Bank is more or less flattish. So that's good news as well, because that's holding one end up. That's a bit of a fight back that we're seeing from the low point of the day. Slip into a short break. On the other side, Manisha Gupta is waiting for us. She'll tell us what's transpiring in the commodity space.
Mid-caps are tumbling, so mid-cap index is down 400 points, 0.7% lower now in the mid-cap index. The advanced decline ratio, which has been positive for the last 4 days, has turned adverse. We've got nearly 3 stocks declining for 1 in the red at the day's low now for the broader markets. But let's talk commodities. Manisha is here with us in the studio. Manisha.
Well, thank you for that. I'm starting with metals here, which have started 2025 on a very mixed note right now. Well, there are 2 things to work on. One is the dollar index, which is trading at around 109. It's a 2-year high, so that is putting some pressure on prices. And on the other side, you had some Chinese data to react to today. While the services PMI was on a stronger note, but the overall PMI numbers did not excite the street. So it was lesser than the previous month and lower than what the street was anticipating as well. I want to start with precious metals because 2024 was a great year. We did see 22% gains for silver and 28% for gold. And this year as well, for 2025, the last 5 or 6 days, the momentum has just about continued and we've seen money flowing in precious metals there. The base metal that seems to be doing well is the copper prices. Remember, for 4th quarter of 2024, we saw the copper prices decline by 10%. It even went down to a 9-month lows. But the first week of 2025 has seen copper prices gain up by nearly 1.5% on the higher side. Well, the street is anticipating that you will see more stimulus measures coming in from China. Of course, much would also depend on the buying interest, especially after 20th of Jan, on how the world changes, is something that's keeping the markets jittery. But at this point in time, the copper prices are starting 2025 on a stronger note. And this is even as the dollar index is trading at a 2-year highs. What is not doing well is the other base metal prices. So when you look at zinc, which gained 13% in last year, has started 2025 3% on the lower side. Aluminum gained 6% in 2024, is 2.5% on the weaker side. Steel and iron ore prices fell in the previous year and have started this year as well on a weaker note, awaiting on what China would really do. I want to take you to the iron ore prices because we saw nearly 25% of decline in the previous year. We are down by 4% for this one in this year as well. It's trading at a 3-month lows. $100 a ton has broken on the lower side there. Rising inventories, weak Chinese data, all of that seems to be bothering. But what is important to watch in this week is really going to be the jobs data, employment data from US. And apart from that, there are various speeches from US Fed officials that would keep the markets choppy as well.
Okay, all right, Manisha, got it. Choppy it is for commodities and choppy it is for equities as well this morning, actually. The good news for the bulls is the fact that there is some recovery from the immediate lows that we were sitting on. And the recovery is happening thanks to some buying on consumer stocks, select consumer stocks, and select BFSI as well as IT names. Speaking of consumer, let's look at the trends that are outlined in the 3rd quarter print. And the stocks are really moving. So you have pizza and lipstick, which is moving higher. I'm talking about Nykaa and Jubilant Foods. But the staples, Dabur, Marico, these stocks are still under pressure. Let's go across to Manglam to get a quick heads up again on those numbers. Manglam.
Well, pizza, lipstick doing well tells you about, the schism that we're seeing in consumer sector while staples are not doing as well. So you have a very, very strong update coming in from Jubilant Foodworks. The consolidated revenue grew 56%. Optically, this looks very strong. But remember, consolidated revenue includes the acquisition of DP Eurasia as well. The number to watch out for is the standalone revenue. There too, it's a 19% growth that the company has reported. And that is led by higher like-for-like growth coming in from Domino's India itself. And they've opened 60 net stores as well. So all these factors working well for them. The important thing we need to watch out for is the like-for-like growth in delivery versus dine-in. Because over the last few quarters, we had seen dine-in decline even as delivery was starting to pick up. So has there been an arrest in dine-in now, the decline out there? Secondly, we'll watch out for the impact on gross margins on account of beverage portfolio changes. Remember, ever since the Bhartiya family went ahead and bought HCCB, they did do a tie-up with Jubilant Foodworks to sell Coca-Cola as well as against Pepsi in the Domino's store. So does that come at a higher gross margin or not? And the third thing we'll watch out for, the growth in their other franchise, which is Popeyes. So that's a couple of things that we'll have to watch out for Jubilant Foodworks. For Nykaa, we did speak to Anchit Nair a couple of days ago on our channel itself when they released their beauty trends report. There they said that net revenue growth will be higher than mid-20s in the 3rd quarter. But importantly, the beauty business is doing a lot better. The growth has accelerated out there. And, this time around, it will be above mid-20s and the gross merchandise value in the beauty business will be in low 30s itself. So it's a good update coming in a sector which was earlier looking for some growth coming by. Fashion business as well for them, which was earlier supposed to be a growth driver, is struggling a little. But there too, we've seen about 20% revenue growth. which is subdued, but the street expects this to improve as consumer sentiment improves as well. Speaking about consumer sentiment, not much improvement in general trade is what we've seen. Dabur had called out this weakness earlier, and that's what's reflecting in their performance this time around as well. But if you look at Marico, the overall revenue growth of the company would be in mid-teens. What's worrying the street right now is that this revenue growth is largely price-led, and there could be some margin-related impact, which the company has called out in their third quarter update as well, where the gross margins have actually fallen a little more than expected.
Thank you for that, update, exhaustive update. It's now over to Abhishek for Union Bank.
Well, Rima, I don't remember the last time for a sustained period of, let's say, 2 to 4 quarters that Union Bank of India did gain market share. Very weak business momentum coming in over there. A deposit growth at 3.8% YOY, decline of 2% sequentially. In that, the domestic deposit growth is just 2.5% YOY and a decline of, around 2.4% sequentially. Advances growth is close to 6% YOY and 2.2% sequentially. In that, the domestic advances have grown by 5.3% YOY and 2% quarter-on-quarter. The domestic RAM, that is retail, agri as well as MSME, which has been the focus area of all the lenders, that is up only 6% YOY and has declined by 1.5% sequentially. So a weak business update is being factored in the stock price in trade today. Back to you.
Okay, indeed, and Union Bank is leading the entire PSU banking pack down with it, but the numbers on deposits probably the weakest for Union Bank. Thank you for that, Abhishek. Very quickly, back to Mangalam to wrap this up. ITC, the demerger of the hotels business finally happening. Mangalam,
yes, the
price is on the screen now.
The price is on the screen right now, and if you compare the opening price to the previous close on ITC, it would be a difference of around 26-27 rupees, which is slightly higher than what the street was anticipating. More on the street, we're working with a number of anywhere between 15 to 20 rupees per share of the hotels business, and now the stock price is correcting to that as well. So it will be very interesting to see how the hotels business lists now sometime in mid-Fed. The stock opened lower by 26 rupees per share. That implies that the hotel business could be valued at close to 54,000 just basis the stock price move. The real, proof of what the hotel business is valued at will be when the hotel business lists in mid-Feb itself. But once again, to, jog your memory on the hotel business, first half of this year, revenues were closer to 1,500 odd crores with 28% margins, assuming they do 4,400 crores revenue by FY26 with close to 1,450 crore in terms of EBITDA. Valuing it anywhere between 26 to 28 times, which is a discount to Indian hotels and a premium to all the other players. This could be worth nearly 175 to 190 rupees per share. But the street believes, basis the price difference right now, it could be valued at a little higher. But the proof of that will lie in when the hotel business lists.
Okay, all right, Mangalam, thank you very much for that. With that, we have to slip into a quick break. On the other side, our special segment, It's the Economy. Lata today will be in conversation with Shantanu Chakrabarti of BNP Paribas to discuss what the early advances in deposits growth data indicate about the Q3 performance that can be expected from banks.
Welcome back. Indian stocks in general and the Nifty Bank in particular have plunged into the red following Asian markets and probably as a result of the strong dollar and US yields. But the bank stocks are also reacting to the early Q3 deposits and advances disclosures. For a majority of the banks, deposit raising has been a struggle, and the way the early data is showing, it looks like NIMs or margins are going to be under pressure when the full results come. For HDFC Bank, it's the other way around. It appears that not margins, but the volume of loan growth will be a bit of a letdown. To analyze the early numbers from banks, I have with me Sandhanu Chakrabarti, the head of banking and finance company analysis at BNP Paribas. Santanu, good morning. Thank you very much indeed for joining us. And well, it's still the first week of the new year, so a very happy new year to you and everyone at your company and your family.
Thank you, Lata. Good morning and a very happy new year to you too.
Thank you.
I just heard you speaking about the deposit numbers, and just looking at liquidity in December, you'll see where those numbers are coming from.
Oh, absolutely. It was tight liquidity. But you know what? Since the market is more preoccupied with what is dragging down the indexes, I'll begin with HDFC Bank. It's not the one that's lost the most, but willy-nilly, even if it is in the red, it pulls the Nifty Bank a goodish bit. What have you made of the numbers? That 3% loan growth is after having sold off 46,000 crore of loans this year. Otherwise, the number would have been different.
I mean, otherwise also on their base, the number doesn't look blazingly different. And frankly, the loan sale downs tell us more about their approach towards, profitability and pricing consciousness, rather than have a material impact on the size of the balance sheet at this point. This was true of the, mortgage sales that they did in the first half, and it remains true even at the end of the third quarter. But gives us a sense that they are very cautious that the money that they're raising incrementally is high cost money, and therefore the asset users it should be put into should be commensurate to the cost of that money and the nature of that money. So for example, in this quarter's early release also, Lata, you'll see that their focus the growth has been primarily in what they call CRB, commercial and rural banking, and retail, and wholesale, which is corporate, essentially still continues in shrinkage mode, and that follows the plan to a T. Having said that, is 0.9% quarter on quarter a low number? No doubt about it. But the interesting thing about
Shantanu, the question I have about HDFC Bank is, first, what do you expect their margins to be? My sense is the margins are going to be as good or better than the previous quarter. But ultimately, EPS or profit is both volume and value. So margins are high, but volume is going to be low. So what is your EPS forecast, ROE, the entire, how do you approach the bank?
Right. So, in this part of the interest rate cycle, the cost of funds for most banks have kind of matured. So margin erosion, to start with, which drifts down into ROA and ROE, is not material for any of the major banks. HDFC is a special case where HDFC, because of a very, somewhat irregular liability structure that it's coming off and it's gradually rationalizing, you might actually see even better performance on a sequential basis on margins vis-a-vis other banks, right? And now the moment you see that they have been able to move deposits up by 2.5% sequentially, not a large number, but a meaningful number, a 64,000 crore number is not small in the context of what's happened in the system in the last quarter, especially in December.
Fair enough.
And in that context, I think, the margin surprise, which the market reacted so positively to last quarter, that positive margin surprise could come through. Now, I hear your point around how profits are ultimately a function of both loan growth as well as margins. But I think in HDFC's case, especially if people have a price to book prism on valuations, they're trying to figure out what steady state margins and therefore ROAs and ROEs look like, and better and improved optics on that on a sequential basis, I think is going to weigh heavier than, what the EPS number looks like.
Okay. So what would your price to book forecast be for the year? And I think you have the biggest price target on this street, 2,550. Right. Yeah. Okay.
Right. So, look, I have still some way to go before re-rating it back to what it used to trade at. But I'm just saying that at 2.1 time price to book, it's probably, if you strip out the subsidiaries, it's probably trading at a valuation that better suits a wholesale lending NBFC than a retail dominant bank, even if it's with low CASA. And therefore, my target multiple is around 2.8, right? And that gives you that much of upside. And I think the path to achievement of that multiple is that margin improvement and therefore consequent impact on ROE.
Okay, fair enough. Let me quickly look at the other banks. More generally, what have you taken away from all the other private sector banks? We don't have too many of them. We've got IndusInd, RBL, CSB. Many of them are smaller banks. The big Axis ICICI are not out. But what have you made of the private banks? I'll come to the PSU in a bit.
And so, the one which stood out for me was IndusInd. So IndusInd's growth number, now I can understand there's some stress in the MFI sector and it's hard to make a segment commentary at this stage from the early releases, but the numbers on both assets as well as liabilities looked a little lackluster, to be honest. And there's a takeaway from there as well. And Bank of Baroda has also put out numbers today, and their growth is about 9.5%. Yeah, I heard the previous anchor was also speaking about Union Bank. So their numbers have not looked great. So overall, I think the tightness of liquidity is starting to bear down on deposit growth. But what is quite interesting, Lata, is at least the CD ratio aspect of it is no longer a topic that seems to be in play. Because if you look at the last fortnight's disclosure, you'll see the loan growth and deposit growth, as we had expected, has exactly converged to 11.5%. I think easier liquidity is required.
Yeah.
And
no,
that's
I would assume,
even more than easy amount.
I would assume
for
we will
the
hear
growth to
of.
Accelerate.
Yeah, I agree with you. I think we will hear of OMO, OMO purchases by the Reserve Bank, and probably at the lower end of the curve, not at the 10-year, but definitely at the lower end of the curve, there will be liquidity that they will provide. But there is a separate story on the kind of pressure we are seeing on the currency. On Friday, the Chinese PBOC has allowed the currency to go beyond 7.3. And today, the offshore currency is 7.36. So, we don't have too many options. We will have to let the rupee go, perhaps. And right now, as I speak, 85.80 has been given up by the Reserve Bank. They seem to be protecting it last week. Today, they've given it up. Okay, coming back to NBFCs, then I'll come to the PSU banks. What's stood out for you? Bajaj Finance, winner all the way?
5 million customers added, Lata. I've been looking at this. It's my top pick in NBFCs, okay? But just,
even at this price,
irrespective of what view you have on the company, to look at that and appreciate. In this environment, to add 5 million new customers, it is a stunning achievement. And their growth is tracking. Now, there's no comment around asset quality. But if asset quality pressure was a major concern, would they have grown at 28?
Okay, any PSU bank you like?
So, SBI, we have just gone to neutral because, the pricing appears a little more full to us at this stage. But we like the setup. There's nothing wrong there as far as we are concerned from a business perspective. But just that relative to what we have available on things like HDFC Bank at this point, we have moved to a neutral on a sector basis because our recommendations are sector relative.
Okay. What intrigues me is I think you have a coverage on SBI cards. That still remains underperformer, right, for you?
Right.
I guess
yes,
likely
it does.
so.
Yes,
okay.
it does. The regulatory pressures and the business has structurally changed. I don't mean just the SBI cards business, the credit cards business. The revolvers, a lot of them have become essentially EMI customers. And even in a period where you're seeing some stress, you still do not see revolver behavior, right? So something has fundamentally changed about that business, with implications for profitability and ROE generation capability of that business. Apart from that, all the regulatory overhangs continue to exist. On top of that, when I see valuations which are probably a little richer than Bajaj Finance, it's very hard to make sense of them on a relative basis.
Okay. Overall, how does BFSI figure for BNP Paribas? I mean, this is, of course, your strategist question I'm asking you. But you tell me, what do they think? Should we even chase banks? Or should we really wait for even 6 more months for liquidity to return and banks to get more comfortable?
Right. So the BNP Paribas view throughout the last year has been, that we have preferred banks and IT. That's what our strategist Kunal has preferred. Now, within banks, not much has fundamentally changed, right? I mean, maybe in the beginning of the year, if we would have thought about a September or a December cut, and now we are talking about a February cut. But other than that, if you look at the overall setup of the business, nothing has really changed. And I suspect that, therefore, banks will continue to, feature prominently.
Let me put it this way. Let me put it this way, Shantanu. Have deposit costs peaked? Have margins bottomed? Or you think there is more of margin erosion left to come? And for how many quarters?
So the answer to that is, as far as our pre-cut basis is concerned, both of those things have happened in a material sense. I mean, 1-2 basis points here there is different, because what were the costs hardening from? The costs were essentially hardening from the repricing of the FD back book. Now that is done. If you look at the existing FD books of banks, what their implied yields look like, and the incremental pricing on which they're raising FDs, they're both at par. I mean, for most banks, that's about 7.25%, right? Okay. And so incrementally, the only pressure on cost of funds is the extent to which FDs increase in proportion of total funds. That's about it. That's a couple of basis points here, there. Okay. What happens is margins actually bottom after rate cuts, because remember, a very large part of the loan book is repo linked. And a slightly larger part will become repo linked the moment rates get cut. I'm talking about top corporate exposures, which will go to the lowest rate. So the margins bottom after that. From that point onwards, you have stable to slightly improving margins, which creates a great earnings growth setup for FY26.
So in short, margins still have to suffer. And it's only after the rate cuts that we are going to see them improve. For broadly the sector, exceptions notwithstanding.
Right, but until pre-rate cut, you are not going to see too much of turmoil in margins. It will be around this level.
Okay, got it. Thanks a lot. Thanks a lot, Chandru. Out of time, and we will touch base after the big banks announce their numbers. Thank you very much indeed for joining us. And as we wind down on Bazaar, the markets are still indicating a lot of pain. The Sensex and the Nifty are holding up, but mid-caps quite clearly under pressure. And I think the pressure is coming from global factors. Wrap up on that note. Chartbusters coming up.